I think I need some more ones than this. I need more ones than this. More people should have their notes out. Note takers are money makers, period. Okay, bet. So we're going to go ahead and get into it. I got a little PowerPoint for y'all. So I'm going to go ahead and share my screen. Once y'all can see my screen, just drop a 2 for me. All right, go ahead and drop a 2 for me if you can see my screen and if y'all can still hear me. Okay, bet. So get into this. All right, boom. Risk management. How do I make this bigger? Okay, we're going to use this little PowerPoint. Let me zoom in. All right, so what is risk management? So risk management is basically when you are cutting down your losses so that you can have greater wins. Risk management is going to help you as far as like winning more than you lose, not over leveraging your account and not blowing your account basically. So it cuts down losses in trades and, like I just said, prevents you from blowing your account. All right, so boom. First thing is counting pips. So as y'all know, when it comes to risk management, it really has the most to do with your lot size. So you have to be able to understand what different lot sizes mean when you are following proper risk management. So we're going to start with the different types of lot sizes. So first things first is going to be the the micro lot size. First things first is the micro lot size. So this is a 0.01. This is the smallest lot size. All right. So a 0.01 is going to mean that you're putting in 10 cents to the trade. So you're making or losing 10 cents per pip. So basically, when it comes to the market movement, it moves in pips, which is just the unit of measurement. It's just like, think of it as like inches or feet or something like that, right? So if the market was to go up a pip in a buy, you would gain 10 cents. If it was to go down a pip in a sell, you would, gain 10 cents, or vice versa. You would lose 10 cents if it was going in the opposite direction. Now, the next lot size is going to be a mini lot size, which is $1 per pip. So that just means that you're gaining or losing $1 for every pip that the market moves. And then you have a standard lot size, which is $10 a pip. And same thing, you're gaining or losing $10 for every pip that the market moves. Now we're going to get into this chart, and I would suggest if you don't have this chart, you can go ahead and screenshot it because this is really helpful. So with this, it's basically going to be telling you what lot size you should be using based on your account size. So let's say you have $100 account, and let's say you're in a trade and the trade is has a 10 pip stop loss. It's telling us right here 0.1. Use a 0.1 for that trade. If it's a 20 pip stop loss, use a 0.05. And I'm going to explain how they got these numbers in a second. But 30 pip stop loss, 0.03, 40 pip stop loss, 0.02. So it's literally telling you what lot sizes to use based on your account size and based on the trade. Now, when it comes to finding your lot size, you want to only be risking 10% of your account. You want to follow that 10% rule so that you're never risking more than what your account can handle. So if you have $100 account, you only want to be risking $10 out that $100 because that's 10% of 100. You have a $50 account, you only want to be risking $5 at once on a $50 account. So following this 10% rule is going to help you by, you're not going to be over leveraging. Now, if y'all see, if we have a 10 pip stop loss and we put in a 0.1, and we know a 0.1 is $1 per pip, if it was to hit stop loss, we're losing $10. We're losing $10. Now, if we look at the next one, a 20 pip stop loss, we put in a 0.05 because we know that is 50 cents per pip off of 20 pips. If we was to lose 20 pips, that would add up to $10. All right. So basically with your lot sizes, you only just want to be risking 10% of your account. And yeah. Next thing is going to be our stop loss and take profit. So I'm sure a lot of y'all already know how stop loss and take profit works. So we're going to start with take profit, right? So take profit is the point where your broker automatically takes you out of a trade. So whenever your trade hits that price that is set for the take profit, it's going to automatically close, and then you'll see it in your history. It'll be a little green line on the side next to it, and that's how you know it hit take profit. And another thing is, don't watch your trades. Do not sit there and just watch your trades and get stressed out by it. Like this, you watching it is not going to help. You watching it, the market is not going to say, oh, she's over here stressed about the trade, so let me make it turn blue. Like the market does not care. It's going to do what it does regardless. So it's no point in you sitting there and just staring at it. Like just staring at it, telling it go blue, go blue, go blue. Like, no, there's no. So understand that every single trade is going to start out red. You put your parameters on there for a reason. So like, as long as you have your parameters, you shouldn't be worried about it. Only time you're going to be stressed on a trade is when you know you're doing something wrong. Like when you know you're over leveraging, when you know you're doing something you ain't got no business doing. That's the only time you should be stressed about a trade. But yeah, so take profit, it automatically closes you out. And understand that every single trade is going to start out negative, so don't let that stress you out. Just let the market do what it does. Now, stop loss is really important. When it comes to stop loss, it's going to ensure losses won't consume your entire account. And what was I trying to say? So this is how I think of stop loss, right? Think of stop loss as like a safety net. Stop loss is going to be like your safety net. So a lot of people, they'll be stressed if their trade is going to hit stop loss, but you have to understand that stop loss is there to prevent you from losing more money. If you're using proper risk management, using that 10% rule, you shouldn't be losing more than what you were willing to risk. So think of your stop loss as just a safety net. It's there to catch you from losing too much money. It's there to help you. Only risk a portion of your account according to your account balance. So that goes back to that chart we were looking at, how it had the different account balances and was telling you, what lot size to use based on your account size. And then last thing, you don't want to risk more than 3 to 10% of your account in a trade. Right. Okay, boom. This is really important. So limit your trades. Y'all do not have to hop in every single trade that you see sent out. You don't want to be over trading, because just think about it. Like the more trades you're putting in, the higher your risk is of losing money. Like you're just upping your risk. Get your good two, three trades in for the day, reach your daily goal, and then call it a day. You don't have to enter every single trade that you see. Just because it gets sent out in the chat doesn't mean you have to hop in. Now, another thing is going to be your margin level. So if you're looking at MT4 and you see where it has your balance, your equity, and then it'll have your margin level. So do not let that margin level drop below 200. That's telling you right there that you're risking blowing your account if your margin level is ever under 200, or your broker will just margin you out the trade. So it'll just close it by itself. So you don't want to lose money because you're over leveraging and you have a low margin level and then you get margined out. Even if the trade hits take profit, you have lost it all because your broker will take you out at the point that your account is losing too much. So just think about, you're in a trade and it's going through some pullback and your account can't handle that pullback. You'll easily be margined out and you're going to lose that money even if the trade ends up hitting TP in the end. So you want to make sure that you're not over leveraging to avoid that. To avoid your margin level dropping below 200, just don't over leverage. Okay, so next thing is use appropriate lot sizes. You can calculate your potential loss or profit before you even enter a trade. Okay, so when it comes to figuring out your losses to your profit, basically looking at what am I going to either gain or lose, You can figure that out up front just by knowing, okay, what kind of lot size am I using? And then how many pips is the stop loss? How many pips is the take profit away from the entry point? So let's say that we're in a trade and we have a 20 pip stop loss, right? And let's say that we use a 0.1, which is telling us, okay, we're putting in $1 in this trade. So it's going to be $1 per pip. We're either gaining or losing. So let's say we got a 20 pip stop loss and we have a 40 pip TP, right? So for us to calculate our losses to wins before we even enter the trade is we know if we're putting in $1 per pip, then if it hits stop loss, we're losing $20. If we put in $1 per pip and it hits take profit, we're gaining $40. So we're risking the risk to reward ratio is basically going to be a higher reward for a lower risk. You don't ever want to put in a trade and then you're risking more than what you're going to potentially gain. It would be backwards for us to enter a trade and we might lose $40, but then we might gain $20. Like, that's backwards. So you always want to be potentially gaining more than what you're risking. And then this is a big thing. Do not try to get your money back off of a trade and just hop back in and basically revenge trading. Don't try to hop back in to get your money back. If your trade hits stop loss, then it is what it is. Go look at a different pair. Go on about your business. Don't try to hop back. Okay, so I'm gonna tell y'all a little story. So when I was starting out with trading, what I would do is like I would just pip and dip indices like on some dangerous, like, no, don't ever do this. Okay, so I would just be pipping and dipping indices, and I would hop in for the buy. If I lose money on the buy, then I would turn around, hop in for the sell, and I would just be going back and forth, back and forth. So that's literally revenge trading. That's revenge trading, trying to make your money back off of a trade, trying to hop in for a buy after you lost money on a sale. Like, nah. Then next thing is you will lose some trades, so don't trade with emotions. This is probably one of the biggest things when it comes to trading is the way that you think when you're trading. You can't feel no type of way just because you lose money. You can't be in your feeling just because you lose money. It's the financial market. You can't control the market. Nobody can. Like, it is what it is. At the end of the day, it's a $7.2 trillion market. Like, you're gonna make your money back. So if you lose a trade, don't sit there and just beat yourself up about it. It is what it is. Keep it pushing. And just understand, like, you could lose $5 on the trade. If you lose $5, that means somebody else lost $50. That means somebody else lost $500. That means somebody else probably lost like $5,000. So you just gotta understand, okay, yeah, you might have took a loss, but it is what it is. It is what it is. Don't feel no type of way just because you lose a trade. Next page. Okay, so boom, stick to your trading plan. Stop trading when you hit the daily profit goal. So y'all know that our daily profit goal is $20 a day. So once you hit your $20 and you're good for the day, just stop trading. Because that goes back into over trading. You don't want to be trading more than you need to. So stop at your daily goal, and the more trades that you hop into, the higher you're upping your chances of losing one. Okay, boom. I would suggest y'all screenshot this if you need it. Screenshot this if you need it. These are the account sizes that you need for different indice pairs. So when it comes to trading indices, y'all know that indices move really, really fast. They move really, really fast, and they're going to experience pullback, things like that. So if you don't have the account size to hold that pullback, you don't need to be in the trade. So boom, we got SPX 500. You want to have over $50, US 30, you want to have over $300, German 30, over $300, and then for gold, you want to have over $100. All right, so if you need that, you can go ahead and screenshot it. I'm gonna give y'all a couple seconds. Okay, boom. All right, so boom. if y'all don't already know, the market does have open and close hours. So the market closes every Friday at 5 o'clock p.m. Eastern Standard Time. The market will close at 5 p.m. Eastern Standard Time, and then it's going to open back up on Sunday at 5 p.m. Eastern Standard Time. All right, so before 5 o'clock on that Friday, you want to make sure that you're out of all your trades. Before 5 o'clock comes on Friday, you want to make sure that you get out of all your trades, because when the market opens back up, it could spike in either direction and could, mess up your account, have you hit stop loss, all that. So just make sure you just close your trades before the market closes. And also the market closes every single day between 5 and 6 p.m. So before 5 p.m., you can just take your stop loss off and then put it back on when the market opens back up. Okay, boom. So some tips when it comes to risk management. Only trade with money that you are comfortable losing. All right, so don't put your rent money in your trading account. Don't put your phone bill money in your trading account. Only trade with money that you're willing to lose. So when you fund up your account, feel like you already spent the money. Like, think of it as you already spent that money. That way you don't feel no type of way whether you gain or lose money. Like, it is what it is. So don't spend money. Don't fund your account with money that you know you're going to need. You can also maximize profits by twin trading or re-entry trading. Always set a TP and a stop loss. Market manipulation can take your account out. And then scalping versus swing trading. Are you a trader that wants to hold trades for a few hours max or for days at a time? See what you're comfortable with. See how you like to trade, all that stuff. And boom, that is the end. I'm gonna come back real quick and y'all let me know if y'all have any questions. Let's see. Okay, so any questions about risk management? Any questions about anything that we just went over? Y'all let me know now, because I don't want to see no blown accounts. Would the risk be different in HFX? When it comes to HFX, it tells you up front how much you're gaining or losing. So I want to say the risk percentage is supposed to be 3% on HFX. Only risking 3% of your account on HFX. But like at the same time, don't risk more than what you're willing to lose. Okay, yeah. Any other questions? Any other questions? All right, so if nobody has questions, go ahead and drop some 3s in the chat if you understood everything, if you're good to go, if you're not gonna blow your account. Drop some 3s for me. Let me know. I need to make sure everybody's good before we get off of here. Make sure everybody's straight. Cause I'm telling y'all couldn't be talking about you blew your account. I'm like, I told you to ask me questions while you had the chance. Okay. Looks like everybody's good. If y'all are good, I'm good. We're gonna go ahead and wrap this up. Now, actually take this information and use it. Actually apply the information. Don't just hear the risk management information and ignore it. I'm telling y'all, it's gonna save you a lot of money following risk management, even if it seems tedious to you. But that's all for today. If y'all need me, hit me up on Telegram. And that's pretty much it. I'm gonna let y'all go. Have a good day, everybody.